Hello students, welcome to week 8 of Accounting Principles, our last week. Yay! Uh, as always, be sure to watch this week's devotional and don't forget to read the assigned chapters from the course text this one last week. All right, let's take a look at week eight's learning objectives. This week, one of our major topics is from chapter 17 and the other one is from chapter 22. So a two-chapter week this week. From chapter 17, we're looking at how to distinguish managerial accounting from financial accounting and explaining how managers recognize cost and define product or service unit cost. We're also looking at how managerial accounting supports the management process to produce business results. The role of managerial accounting is to enable managers and other decision makers in the business to make informed decisions, to be more effective at their jobs and improve organizational performance. This chart on this slide is also in your book, but I wanted to show it to you now so you remember to go back and check it out later in the course text. It's a great comparison between the essence of the differences between managerial and financial accounting across the different contexts of business. So be sure to study it. It might be on the quiz. The fundamentals of managing an organization include planning and forecasting operations, organizing and coordinating resources and data, and then commanding and controlling resources. It's some of the basics of management. Now, as you read through this chart from left to right, notice all the areas where financial data is important. So, for example, I'm just going to pick out one of them. Underneath the perform activity, there's a sub-activity of establishing the cost of the product or the service. That's a pretty important function that accounting would help with. Imagine trying to establish that product costs or service costs without any horizontal analysis like we talked about from last week, where you can look over time about what's been able to sell at what price point. If you don't have the information, you're just kind of guessing at that point. So make sure you pay attention to all the critical analysis that has to be done to feed into the management function as you go. All right, so there's more in chapter 17 that I can cover in this particular overview. Be sure to read the details of this in chapter 17 as we wind up the course. But let's take a peek at chapter 22 where we're talking about budgeting. Our learning objectives from chapter 22 include budgeting and how it relates to the concepts of comparability and understandability. Don't forget the concept of faithful representation as well, which is like the umbrella over all of this, that we have to be truthful and with integrity present numbers. But we're also looking at the elements of a master budget in different types of organizations and different types of businesses, and the guidelines for preparing those budgets. We're also going to take a peek at that. And also understand the process to prepare both the operating and the accounting or finance budgets. Budgeting is the process of identifying, gathering, summarizing, and communicating financial and non-financial information about an organization's future activities. And you may have participated in some budgeting activities where you work today. If not, you will for sure in the future. Budgets are plans of actions, but they also provide decision makers the opportunity to match their organizational goals and their vision with the resources necessary to accomplish those goals. In a way, the budget reflects any business's heart and mission. If something's important, it should get budgeted. For each type of business, there is a slightly different budgeting process, but shown here for an example is the process for establishing the budget for a service organization, which might also include a nonprofit as well. Many nonprofits would be considered service organizations. In the course text are the budget processes for other types of businesses like manufacturing and retail. But in this particular slide, you'll notice there are two types of budgets being developed almost in parallel. One is the operating budget, which captures the cost of labor and goods to produce the service and that sort of thing. And this budget is often started with a projection about the revenue from the upcoming year from the sales department or the marketing department. But then notice the output of the operating budget is the input to what we would call the financial budget. In reality, these two things work together, the operating budget and the financial budget. They kind of go on at the same time, ebbing back and forth, but definitely the operating budget is the feed for the financial budget. Now, the financial budget captures how the cash will flow month to month, what the net income will look like, when capital is going to be required, and it would even estimate when extra financing would have to happen to go out and fund expansion or bills, take care of bills if there's a predicted dry time coming up for cash. So the operating budget and the financial budget work together to help the company meet its annual objectives. Budgets are key to accomplishing an organization's strategic plan. They're used to communicate information, coordinate activities, rally the troops, motivate employees, and get everybody going in the same direction. Don't underestimate the power of a good budget. All right, that's it for now. Remember to get your discussion questions, quizzes, and assignments in on time as we wind up this course. And as a reminder, I cannot accept any late or missing assignments after the course closes on Sunday night. So don't wait until the last minute to get these things done. I won't be able to give you an extension. All right, as always, remember, God is on his throne. He's always been there, and he's always going to be. Have a wonderful week.